Hello everyone, I am Dr. Shrikant Bause, Assistant Professor at Department of Advanced Management Studies, GS College of Commerce, Varda. In the subject of investment analysis and portfolio management, we have seen the different investment instruments and the risk associated with them and the returns associated with them. From today onwards, we are going to start the portfolio theory, in which we are going to study the complete risk associated with the portfolio as well as the risk associated with the individual securities. When you are investing in any security, at that time that security carries individual risk, and when you are holding a basket of securities which is termed as portfolio, it also carries a combined risk. So we are going to study the portfolio risk from this video. Here we have to first understand the concept of portfolio. Imagine that you are a retail investor and you would like to invest in different stocks of companies. In this month, you bought the shares of Hero Motocorp. Last month, you bought the shares of Dr. Reddy's. Last to last month, you bought the shares of HDFC Bank, and before that you bought the shares of few more companies. Now imagine that you invested 1 lakh rupees in Hero Motocorp, 1 lakh rupees in HDFC Bank, and 2 lakh rupees in the Dr. Reddy's, and before that you have invested in 3 to 4 companies with 50,000, 60,000 amount. Now the name of security, then the respective number of shares, and the respective amount invested by you. If we tabulate it, it will become your portfolio, that in how many companies you have invested, in which companies you have invested, and how much shares you are holding, and what is the value of that shares, at what rate you bought the shares, and at this moment of time what is the current market price of all those shares, and at last the combined value of your portfolio when you invested and the present value of your portfolio. So this is the simple concept of portfolio. Now we will go ahead. Portfolio is a basket of securities in which you will keep the stocks of different companies. Suppose this is a basket and you are keeping the stocks of different companies in this basket. Now this is the era of digitalness. Each and every security is dematerialized, so it will not be in the physical form, it will be into the electronic form. Now when you are buying the shares in the portfolio, you are focusing on the risk diversification. How? Suppose you invested entire 10 lakh rupees in single company, and overnight a scam happens or a fraud happens with that company. Tomorrow when the market opens, you come to know that the stock prices, the share prices of the stock where you have invested 10 lakh rupees went down drastically. Imagine if they are on the lower circuit where you are ready to sell, but no one is ready to buy. If such condition arises for consecutive days, it may also happen that your 50%, 60% or 70% or even complete amount will get wiped out. So this is the risk associated with the single stock. On the other hand, imagine if you have invested 1 lakh rupees in one stock. In this way, 1 lakh rupees in 10 different companies' stocks. At that time, your risk would have been diversified. If any one company becomes bankrupt, the remaining 9 companies will be as it is. So, this is the significance of diversification. There are two types of risk. Broadly, first one is the market risk and second one is the unique risk. In the month of March, in the last week of March, no one was knowing that the government of India will announce complete nationwide lockdown. But one day it was announced, and on the immediate next day, the broader indices and complete stock market witnessed a huge fall. Now this is called as the market risk. This risk is not associated with a single or 2 or 3 companies. This risk was associated with all the stocks in the market. So this is called as the market risk. Now, yesterday only we came to know that there was a fraud in PNB by one of its big borrower, Syntex. So this is a unique risk because this risk is associated with only PNB and Syntex industries. So there are two types of risk, market risk and the unique risk. Now when we are studying the portfolio risk, we have to consider both of these risks. So the total risk will be unique risk plus market risk, because no company can keep itself away from any of these risks. It is exposed to either total risk, market risk or even unique risk. No one can predict that what may happen overnight or what will happen tomorrow. Now we are going to start with the portfolio return and risk. In the university examination, this is one of the favorite question of paper sitter, that calculate the portfolio expected return or the expected return of the portfolio. So when there is a portfolio, there are two things associated with that. It will give you return, but there will be risk associated with it. So now we are going to study that how much risk is associated with the portfolio and how much return we will be able to earn. So which is called as the expected return. The formula for this is summation of Ni is equal to 1 Wi E in bracket Ri bracket complete. Now here E means expected, R means return, P means portfolio, expected return on portfolio. So ERP is expected return on portfolio. How we will remember it? Simple. Expected return on portfolio, ERP. Now WI means weight of the security I in the portfolio. As we all know, that there are different securities, different stocks in the portfolio. Each and every stock may be having different weightage as per the view or confidence of investor. So W is the weightage of security I in the portfolio. Then ERI means expected return on security. When we are talking about expected return on portfolio, it will be calculated on the basis of expected return on each and every security in that particular portfolio. So ERI is expected return on security I. Then N, here is the N. N is the number of securities in the portfolio. You may hold 3 securities, 5 securities, 7 securities, 10 securities, something like that in your portfolio. But remember that over diversification also leads to high risk. So the ideal portfolio should not be of more than 10 securities. This is my humble ideal view. Next, we will study the numerical, which is based on the expected return of portfolio. This numerical will give a very simple idea that how the expected return of portfolio is calculated. It is very simple. Imagine that you are provided with these 3 figures, that your portfolio is consist of 4 securities: security A, security B, security C, security D. So these are the 4 companies. Imagine in company A the expected return is 12%. Imagine that the stock A will give 12% and you have invested 0.20% in this stock. In the next stock B, the expected return is 15% and you have invested 0.30% amount. In the stock C, the expected return is 18% and the proportionate value is 0.30. In the stock D, expected returns are 20% and the proportionate value is 0.20. So these are the 4 stocks. These are the respective expected returns of these 4 stocks and this is the respective amount invested in these particular stocks. Now what we have to calculate? We have to calculate the expected return on portfolio. How we will calculate the expected return on portfolio? As we have seen this formula, we will simply put this formula here, that expected return on portfolio is equal to summation of n I is equal to 1 weightage of security I multiplied by expected return on individual security. What we will do? We have to just put these values in the formula. It is very simple. The first proportionate value is 0.20 multiplied by 12%, proportionate value multiplied by 12% plus next proportionate value, that is 0.30 multiplied by 15% plus the proportionate value of C, that is 0.30 multiplied by its respective expected return, that is 18% plus again proportionate value 0.20 multiplied by its expected return, that is 20%. Now we have taken the summation of weightage and expected return. 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 Keep this in mind, very simple. This proportionate value multiplied by expected return, this proportionate value multiplied by expected return likewise. Now when we are multiplying 0.20 by the 12%, the outcome is 0.024 plus 0.30 multiplied by 15%, outcome is 0.045. Then 0.30 multiplied by 80%, the outcome is 0.054. Then 0.20 multiplied by 20%, the outcome is 0.04. Now when we will sum up all these four values, the answer is 16.3%. So the expected return on portfolio is 16.3%. In this simple numerical, we have completely studied that how to calculate the expected return on portfolio. We have to simply multiply the proportionate value with the expected returns, and we have to sum all the values, and resultant will be your outcome, that is expected return on the portfolio. So today in this video we have studied the concept of portfolio, then the concept of basket of securities, then how to diversify risk, how the risk varies from single security to the portfolio of securities, then types of two risk, that is market risk and unique risk, how to calculate a total risk, unique risk plus market risk. Then we have studied the portfolio return and risk, the formula for calculating the expected rate of return, that is summation of Ni is equal to 1 Wi E in bracket Ri, that is expected return on portfolio is equal to summation of Ni is equal to 1, where Wi is the weightage, Eri is the expected return on individual security. Then we have seen this formula, four companies, their four respective rate of return and the proportionate value. We have to simply put the values in this formula, and we have calculated the expected return on the portfolio. I hope that this has given you the complete idea how to calculate the expected return on the portfolio. Thank you.